The employment crisis is getting worse. The jobs number, it was weak. The Fed underestimating the problem. Long-term trend doesn't look good. We're going to dig into the data and show you exactly where we think the trend is showing the biggest cause for concern. Here's a non-farm payroll release, 151,000 jobs created, better than last month's 125, but not where we want to be. We want to be in the 300s. That was December's number. We're not there anymore. Here's the unemployment rate, ticked up to 4.1%. This is not a huge change. We've been more or less in this area for a while now. The strong correlation that exists, that is concerning. This is a correlation between the odds of a Federal Reserve cut and weak stocks. What does this mean? The orange line, that's the S&P 500. It's been weak. The blue bars show us the probability that the Federal Reserve will not cut interest rates in June. As the bars are going down, it shows us that the odds that they will cut rates are increasing, meaning that weak stock prices are correlated to the expectation or the realization that the jobs market's weakening, that the growth is weakening. That's not a good thing. Now, Federal Reserve Chairman Powell spoke on Friday. Most of the speech was not big, except for one particular point, which I think they're underestimating the situation. Telling us what we already know. They said, despite uncertainty, the economy remains strong. I don't think so. Labor market is stable. Inflation is close to 2%. The Federal Reserve is focused on its dual mandate, maximum employment and stable prices. This is all we know this. Conditions, they say, are not great, but we're taking a wait and see. Well, I say this. They said GDP grew at 2.3%. Growth driven by consumer spending, but there are signs of moderation emerging. And that's not very strong language, but they're hedging something. Business and household sentiment shows uncertainty, but its impact on spending is unclear. So they mentioned spending 2 times here. And essentially, they're concerned that spending, well, it's showing signs of moderation, but we really don't know the sentiment, the negative sentiment, how much that's going to affect spending. We're not too concerned about inflation. Inflation has significantly declined since the 22 peak. That's what they said. Recent data remains slightly above the 2% targets. Progress is uneven, especially in housing and services. Well, if housing is not going down price-wise and a service-driven economy, those prices for services are not going down, is inflation really going down? Not from our experiences. They said inflation expectations remain stable despite short-term fluctuations. Well, we feel a slight short-term fluctuations. I don't think that should be discounted either. This is our plan moving forward. They said the new administration, well, there's policy changes in trade, immigration, fiscal policy, and regulation. We can maintain restraints, meaning not cut rates if inflation does not decline. And they said, and we can ease policy, we can cut rates if the job market weakens and or inflation drops faster than expected. Well, this we already know. But this is where I think they're underestimating the issue. They said, well, we're saying the jobs looks okay. But do they really? February, we know we saw an increase of 151,000 jobs, the unemployment rate of 4.1%. The labor market, they said, is balanced with moderating wage growth, no significant inflationary pressures from the labor markets. But job growth averaged 191,000 jobs created per month since September. I don't exactly know why they're calculating from September to now. It would make more sense to take a yearly average. Nevertheless, we have the data. So we did that. This is jobs data going back to 1940, and every bar shows us the average number of monthly jobs created for that year. So if you take the whole year, add up all the jobs, and then divide it by 12, this shows us how many jobs on average are created every month. Well, this is 2020 through 25. We obviously had a huge loss in 2020 due to the COVID crisis. 21 is skewed because of the recovery. In 2022, we created almost 380,000 jobs. 23, 216, 24, 167. And this year so far, on average, per month, we're averaging 138,000 jobs. There's a trend. The trend's obvious. It's going down. Well, let's go back in time. This is 2004 through 10, the financial crisis. What did the situation look like then? In '05, we created on average around 210. '06, 174. '07, 95, and then '08, negative. Well, how do we stack up? Remember, for 2025, present date, we're averaging 138,000 jobs a month. Where does that put us on pace with the financial crisis? In between 2006 and 2007, that's not really a place I would want to be. In 2006, it created 174,000 jobs per month. In '07, 95. Right now, we're 138. That's pre-recessionary level. Going back to 1997 through '03, ancient history. In 1999, we averaged 265,000 jobs a month. That was nice. In 2000, it was 161. In '01, negative. Again, remember, in 2025, we're averaging 138,000 jobs a month. Well, that puts us on pace to be somewhere between the year 2000 and 2001. Again, pre-recessionary conditions. And the same pattern, the declining line that is occurring now over the past 4 years, it's the same pattern that we saw in 2007 and also to the year 2000. Government layoffs are not factored into the current jobs report. This is something we really haven't dealt with in the past. This is from the Joint Economic Committee from Congress. We know we reported 151,000 jobs created. From that, the private sector contributed 140,000. They usually contribute the most. And then there was another 11,000 created by government jobs. But wait, I thought the government was laying off a lot of people. The government layoffs have not yet hit the tape, not in a big way at least. This is from Newsweek. In February, the government led all sectors in cuts, tracking 62,000 announced layoffs across 17 federal agencies. So if the private sector jobs, let's pretend that doesn't change at all next month, 151,000. Well, that's 140,000. That's the private sector jobs, and then back another 60,000 out. That puts us around 80,000 jobs. That would be a huge headline. It's very interesting to imagine how the stock market would react to that. Well, that bad headline most likely is in our future. So the question I pose to all of you, and please let us know, we're very curious to see the responses. Is the trend in the job growth concerning, or is this just a new norm? Maybe the economy has just gotten used to, poor job conditions. Well, maybe we all have. And what about the government layoffs? Do you think that the stock market is going to, sort of understand that, these are government layoffs, not private sector, but nevertheless, anyone who's laid off, they have less buying power. Remember, the Fed is concerned about consumer spending and poor sentiment. Well, that's another 62,000 people that, obviously are not going to be able to have the same kind of spending habits. What do you think about that? Let us know in the comments. We hope this has been helpful. We look forward to seeing you back soon.